Elon Musk just made a wealth move so shocking that billionaires are calling it genius, and Wall Street is calling it insanity. And here's the crazy part. It's working. In the next few minutes, I'm going to break down exactly how Musk is flipping the entire money game on its head, and why this could completely change the way you build wealth in 2025. Now let me ask you, when you think about getting rich, what pops into your head? Saving? Stocks? Real estate? Forget all of it. Musk's approach throws conventional wisdom straight out the window. And this is coming from the man who's built multiple companies worth hundreds of billions. Before we dive in, you need to understand one thing. This isn't a get-rich-quick trick. It's not crypto, it's not day trading, and it's definitely not some guru's course. This is about adopting a rare money mindset that 99% of people will never touch because it challenges everything we've been taught about financial security. So what exactly is Musk doing that's so different? The core of his wealth strategy revolves around what I call the asymmetric leverage principle. While most people think about preserving their wealth, Musk thinks about multiplying it through calculated risks that have unlimited upside potential with manageable downside risks. But here's where it gets interesting, and this is something most people completely miss when they analyze his success. Musk doesn't actually hold on to cash the way most wealthy people do. In fact, he's famous for being cash poor despite being worth hundreds of billions on paper. When Tesla and SpaceX stock prices soar, instead of cashing out and diversifying like traditional investment wisdom suggests, he does something that makes financial advisors nervous. He leverages those gains to fund his next venture or double down on his existing companies. Think about this for a moment. When Tesla was struggling in its early days, Musk could have played it safe. He could have sold his PayPal fortune, invested in index funds, and lived comfortably for the rest of his life. Instead, he put every penny into Tesla and SpaceX, even borrowing money from friends to pay his personal expenses. Most people would call this financial suicide, but Musk saw it as the only path to extraordinary wealth. But there's a deeper psychological element to this strategy that most people overlook. Musk operates from what psychologists call a growth mindset, but he takes it to an extreme level. Where most entrepreneurs might risk 10% of their wealth on a new venture, Musk will risk everything. This isn't recklessness, though many critics argue it is. It's a calculated understanding of how exponential returns work in high-growth industries. Let me explain this with a simple example. Imagine you have $1 million. The traditional approach would be to diversify this across different asset classes, maybe earning 8 to 10% annually. In 20 years, you'd have roughly $4 to $6 million. That's solid, steady growth that most financial planners would applaud. But Musk's approach is completely different. He would take that $1 million and invest it in something with the potential for 1,000% returns, fully accepting that he might lose it all. This is where his strategy gets really interesting, and it's something that challenges everything we think we know about smart money management. Musk has repeatedly stated that he believes the traditional advice to diversify is actually advice for mediocrity. His argument is that if you truly understand an industry or technology, putting all your resources behind the best opportunity in that space will generate far superior returns than spreading your bets. But here's the part that most people miss when they try to understand Musk's wealth strategy. It's not just about taking big risks. It's about taking big risks in areas where you have an information advantage. Musk doesn't randomly bet on companies or industries he doesn't understand. He goes deep into sectors where he believes he can see opportunities that others are missing or are too conservative to pursue. Take his investment in Twitter, which became X. Most analysts viewed this as a massive overpayment for a struggling social media company. But Musk saw something different. He saw an opportunity to transform how information flows in society, potentially creating a super app that could compete with everything from banking services to video platforms. Whether this vision pays off remains to be seen, but the point is that his decision wasn't random. It was based on his belief that he could create value that others couldn't see. This brings us to another crucial element of his wealth strategy that most people completely ignore. Musk doesn't just invest money, he invests his time and reputation. When he puts money into a company, he's not a passive investor waiting for returns. He's actively involved in making that company succeed. This level of involvement gives him a degree of control over his investments that most people don't have, which changes the risk-reward equation dramatically. But let's talk about something that might make you uncomfortable. Musk's strategy only works because he's willing to accept a lifestyle that most people would find unacceptable. He's talked openly about sleeping on the factory floor during Tesla's production challenges, working 100-hour weeks, and having virtually no work-life balance. His wealth isn't just built on smart investing. It's built on an almost obsessive dedication to his companies that borders on unhealthy. This raises an important question that we need to address honestly. Can regular people apply any of these principles without destroying their personal lives or taking risks that could lead to financial ruin? The answer is both yes and no, and understanding this distinction is crucial if you want to extract any practical value from Musk's approach. The yes part comes from adopting certain mindsets that can improve anyone's financial situation. First is the willingness to bet on yourself rather than just hoping external investments will make you wealthy. Instead of putting all your extra money into index funds, you might invest in developing skills that could dramatically increase your earning potential or starting a side business in an area where you have expertise. Second is the principle of asymmetric risk-taking. This doesn't mean risking everything you have, but it does mean looking for opportunities where your potential gains significantly outweigh your potential losses. This might mean taking a job with a startup that offers equity compensation, learning high-value skills that are in demand, or starting a business with low startup costs but high profit potential. The third principle that anyone can apply is what I call informed concentration rather than blind diversification. Instead of spreading your investments across dozens of different assets you don't understand, focus on becoming extremely knowledgeable about one or two areas and concentrate your investments there. This requires more work and carries more risk, but it also offers the potential for much higher returns. Now here's where Musk's strategy gets really controversial, and it's something that financial experts are divided on. He regularly uses his stock holdings as collateral to borrow money for new investments, rather than selling those stocks and paying taxes on the gains. This strategy, sometimes called buy, borrow, die, allows him to access cash without triggering taxable events while maintaining ownership of appreciating assets. For example, when Musk needed funds to purchase Twitter, he didn't sell billions of dollars worth of Tesla stock, which would have resulted in massive tax bills and potentially driven down Tesla's stock price. Instead, he borrowed against his Tesla holdings, using the shares as collateral. This allowed him to maintain his position in Tesla while accessing the capital he needed for his new venture. This approach works because borrowed money isn't considered income, so it's not taxed. Meanwhile, his Tesla shares continue to appreciate, potentially growing faster than the interest rate on his loans. If executed correctly, this strategy can allow someone to access their wealth while avoiding taxes and maintaining ownership of appreciating assets. However, it also comes with significant risks, particularly if the underlying assets decline in value. But here's something that might surprise you about Musk's wealth strategy. Despite his reputation for taking enormous risks, he's actually quite strategic about managing downside risk in ways that most people don't recognize. When he invested in Tesla and SpaceX, he didn't just throw money at them blindly. He structured his investments in ways that gave him maximum control over the outcome. For instance, Musk made sure he was the largest shareholder and had significant influence over company decisions. This wasn't just about ego, it was about risk management. If you're going to bet everything on a company, you want to make sure you have the power to steer that company in the direction you think will be most successful. He also chose industries where government support and regulatory trends were likely to be favorable. Electric vehicles and space exploration both benefit from government incentives and contracts, which provided a cushion against pure market risk. This is another example of taking calculated risks rather than blind gambles. Now let's address the elephant in the room. Is Musk's wealth strategy sustainable, or is it a house of cards waiting to collapse? This question becomes more relevant as his companies face increasing competition, and his borrowing against stock holdings creates potential vulnerabilities if those stock prices decline significantly. The sustainability question is particularly important because Musk's strategy requires continuous growth to work effectively. Unlike traditional wealth preservation strategies that focus on maintaining capital, Musk's approach requires his companies to keep growing at extraordinary rates to justify the risks he's taking and the debt he's accumulating. Recent developments suggest this strategy might be reaching some limits. Tesla's growth has slowed as the electric vehicle market becomes more competitive. And SpaceX, while successful, operates in an industry with long development cycles and significant regulatory hurdles. Meanwhile, his acquisition of Twitter has been controversial and hasn't yet proven its value as an investment. This brings us to perhaps the most important lesson from Musk's wealth strategy, and it's something that applies regardless of your current financial situation. The biggest risk in wealth building isn't losing money on bad investments. The biggest risk is playing it so safe that inflation and opportunity cost erode your purchasing power over time, while others are building extraordinary wealth. Most people are so focused on not losing money that they never position themselves to make life-changing amounts of money. They diversify away all their upside potential in the name of risk management, then wonder why their wealth grows so slowly compared to entrepreneurs and investors who take more concentrated bets. However, and this is crucial, there's a difference between taking smart risks and taking stupid risks. Musk's risks appear smart in hindsight because they've generally paid off, but many similar bets by other entrepreneurs have resulted in total losses. The key is understanding which risks are worth taking and which ones are just gambling. Smart risks have several characteristics. First, they're in areas where you have genuine expertise or insight that gives you an advantage over other investors. Second, they address large and growing markets where success could lead to exponential returns. Third, they're structured in ways that give you some degree of control over the outcome rather than being purely dependent on external factors. Stupid risks, on the other hand, are based on hope rather than analysis, involve markets or technologies you don't understand, or require you to risk money you can't afford to lose without destroying your financial security. So where does this leave us in terms of practical application? If you want to incorporate elements of Musk's strategy into your own wealth building, start by asking yourself some hard questions. What areas do you understand better than most people? What skills could you develop that would make you genuinely valuable in high-growth industries? What opportunities are you avoiding because they seem too risky, even though the potential rewards far outweigh the risks? The truth is, most people will never adopt Musk's extreme approach to wealth building because it requires a level of dedication and risk tolerance that conflicts with having a balanced life. But understanding his principles can help you identify opportunities to take smarter risks and avoid the trap of playing it so safe that you never build significant wealth. Remember, Musk's wealth strategy isn't about getting lucky or having access to special opportunities that regular people don't have. It's about seeing opportunities differently, being willing to act on those insights, and having the persistence to see long-term strategies through to completion, even when they face significant obstacles. The most important takeaway from analyzing Musk's approach is this: extraordinary wealth requires extraordinary commitment to strategies that most people will consider too risky or too much work. Whether those strategies are worth pursuing depends entirely on what you're trying to achieve and what you're willing to sacrifice to get there. But one thing is certain: following conventional financial advice will never lead to unconventional financial results.